Hi everyone, welcome back to Books and Backbone. I'm Donna Harris, CEO of Bookkeeping Made Simple, your host. And today I want to pull back the curtain on something I've never actually explained out loud. Before I advise a business owner on anything, before I tell them whether they can afford to hire, whether their pricing is working, whether they're ready to take on a new contract, whether the business is actually healthy, I look at 5 numbers. Not the whole profit and loss statement, not a full financial audit, not a 30-page report, 5 numbers. They take about 10 minutes to find when the books are current, and they tell me more about what's actually going on in a business than anything else I could look at. I've been doing this for, I usually say 25 years, but I think it's been longer by now. I think it's closer to 30. But these are the same numbers I come back to every time. And yes, I just gave my age away. I don't like doing that. But anyway, first number is not actually a number, it's a direction. The revenue. How is the revenue trending? I don't want to know what the number was last month. I want to know what the number was 3 months before that. Revenue trend, upwards, downwards, stationary. That is the trajectory is what I want to know, not the snapshot. The trajectory. A business with $80,000 in revenue last month looks completely different depending on what came in before that. If the 2 months before were $95,000 and $110,000, I'm looking at a business in decline. If they were $62,000 and $71,000, I'm looking at a business that's growing. Same number, completely different conversations. That tells me where you are. And that's the number one question people ask me when they ask me to start taking on their books. They say, I want to know where I'm at. This is what tells me where you are. And it tells me where you're going. And where you're going is almost always more important than where you are now. When I look at 3 months of revenue, I'm also looking for the story behind the numbers. People don't realize this, but accounting actually tells a story. And accountants are the ones that can tell you, look at the numbers, see the story, and be able to tell it to you in a comprehensive way. So I'm looking for the numbers behind the story, the ones that tell the actual story that I'm trying to tell my client. Is revenue consistent month over month, which tells me the business has predictable recurring income? That's what we want. Or is it lumpy? Big months followed by flat ones. And honestly, that's what most accounting firms look like. They're big months during tax season and then they drop off to nothing, which tells me that the business is dependent on certain projects or, in accounting terms on tax season. And cash flow management is going to be a little more complex. Now, they both can be healthy businesses. Most accountants do run pretty healthy businesses. They're just very dependent on tax season, for example. But they do require different conversations. And the trend is what's going to tell me which conversation we're going to have. Number 2, I want to know the gross margin. Revenue minus the direct cost of producing it. This is your cost of goods sold. When I'm talking about direct costs, I'm not talking about overhead. I'm not talking about rent. I'm not talking about administrative staffing. I'm not talking about the computers that you're using to do your accounting. I'm talking about what does it cost to drive this revenue? You have your costs. So in my case, as an accounting firm, it would be my salary, the depreciation on my computer that I use for client work. It would be, well, actually, no, the depreciation would be part of overhead. But it would be my salary and Dave's salary because we do direct client work. But it would only be my salary for when I'm doing direct client work. So Dave's salary, he's 100% client-based. His is completely, that's a number I need to know. But mine is mostly administrative, so that's an overhead cost. So I want to know, what is your net profit? What is your gross margin? And the net profit or gross margin is figured by revenue minus the direct cost of producing it. And then there's a multiple to that, so we get a percentage. That's the very first thing I want to know, or the second thing I want to know. And that's actually the number most business owners don't know. They don't know what their gross salary is. They don't know what their gross margin is. The most common answer when I ask that question is a long pause and then, oh, let me look at it. Okay, that pause is telling me something. It's telling me the gross margin tells me if the actual business model is working, not whether the business is profitable, but whether the fundamental exchange of value for payment is structurally sound. So again, if I'm paying for a client's QuickBooks subscription for them, I need to know how much I've been billing the client, how much time we've spent on each client, and then how much their QuickBooks subscription is, and that's basically our direct cost. And then I can figure out if I'm making money on that client or not. So as long as I have those numbers, I can figure the gross margin, and I can figure out if the fundamental exchange of value for payment is structurally sound. A business with strong gross margin has room. They have room to pay for overhead. They have room to pay the owner properly. They have room to absorb a slow month without a crisis. They have room to invest in growth. A business with a thin gross margin is running hard to stay still. It's like being on a treadmill, man. You're running as hard as you can and you're not going anywhere. Every dollar of revenue is working overtime just to cover the cost of producing it. So there's no cushion, there's no flexibility. Every single decision is made under constraint. I've worked with businesses doing millions of dollars in annual revenue with gross margins so thin that they were less financially healthy than businesses doing 400 grand, because the cost of delivering the revenue was eating the revenue alive. If I can only look at one number to understand whether a business is structurally sound, it's gross margin. Number 3, cash position in the 30-day outlook. Now, I've talked about the 30-day outlook. I've talked about the 13-week outlook, actually. I need to know what's going to be in the bank in the next 30 days. Current cash position is a snapshot. It tells me where you are right now. What I also need to know is that position going to get better or worse? And specifically, what it looks like when the next round of fixed expenses hit. Now, again, your fixed expenses are things like insurance and rent and utilities and administrative payroll, stuff like that. That's just part of the cost of having a business, as opposed to direct costs, which are the cost of actually providing a service or a product to one customer. So a business with $40,000 in the bank could be fine. Sounds like a lot of money to me. Sounds like a lot of money to a lot of people. But until I know that 38,000 of that's going to go out in the next 30 days for payroll, rent, insurance, vendor payments, etc., that are due in the next 2 weeks, now this starts to look precarious. A business with maybe $15,000 in the bank looks tight until I know that they've got $60,000 in client payments confirmed and incoming this week. Now it looks healthy. So the number without the context is just a number, and that's where I think a lot of people really get confused. They look at their financials and their eyes glaze over because they're not thinking about the context. And that's why the 13-week the cash flow forecast I talked about earlier is so valuable, because it makes that 30-day outlook visible without requiring anyone to hold all the variables in their head at once. When I look at a cash position and the 30-day outlook together, I can tell whether the business has room to breathe, or whether it's operating with so little cushion that one delayed client payment creates a genuine crisis. The 4th number I'm looking for is accounts receivable, specifically AR days. So AR days, which is a term I learned very early in my accounting career. I was working as an accounts receivables clerk for a hospital back east. They would talk about AR days, and like the idiot that I was at the time, 20-something years old, and I just don't know anything. And we all go through that. So if you're 20-something and you're going, oh my gosh, you just called me an idiot, I promise you grow out of that. We're all dumb in our 20s. Anyway, AR days. How many days does it take to collect an invoice from the day you generated the invoice to the day it's paid in full? So if they are Under 30 days, that's normal. That's part of the ordinary rhythm of business. Invoices go out, payments come in, the cycle turns. But if they're at 31 to 60 days, they need attention. Doesn't mean you have to panic, but they do need attention, because the longer things sit in receivables, the harder they are to collect. Receivables past 60 days are cash the business has earned that is not coming in. And the longer they sit, the harder they are to collect, and the more they distort the financial picture. Here's what most business owners don't realize. Having a large outstanding receivable on your aging report makes your business look more profitable than it is. There is a thing that we use called bad debt. We usually have an allowance for bad debt kind of built in. But anything that gets written off or sent to collections needs to go to the bad debt expense, because now we know how much of your revenue is just being held up. Okay, so we don't want anything that's sitting on the books that makes the business look healthier than it is. We want an accurate picture of the business. So this is all money that exists on paper, but it doesn't exist in the bank account. It didn't go to pay any bills. It didn't go to the owner's pocket. It didn't do any of that. Decisions made on that inflated number are decisions made on a foundation that just isn't real. When I see businesses with a significant balance past 60 days, I know two things immediately. First, cash flow is probably tighter than the bank balance suggested, because no one's keeping a track of the accounts receivable. Second, there are client conversations that haven't happened yet that need to happen soon. The aging report is where the collections problems hide before they become write-offs. Looking at it weekly, and I do mean weekly if not daily, is one, not monthly. Monthly is way too long. Not quarterly. You've lost it then. It should be daily to weekly. And that's one of the highest return habits a business owner can build. And the fifth one is owner compensation. Specifically, what is the owner paying themselves relative to what it would cost to replace them? Now, when I look at a business profit, that profit number is only meaningful if the owner's compensation reflects the true cost of their labor. A business that shows $130,000, $150,000 in net profit, but it pays their owner $40,000 a year to do a job that would cost $100,000 to replace, is not a $150,000 profit business. It's a business with $90,000 in hidden labor costs that aren't showing up in the expenses, which means the profit's inflated. Which means every decision based on that profit number, can we afford to hire? Can we take on this lease? Is this business healthy enough to sell? It's based on a foundation, once again, that's not real. Now, I consulted with a client when I was working for a different company. I was the head accountant there. I was working with a good friend, and he brought in this client that said, well, I own my business, and to be fair, he basically set himself up as a job. But he said, well, my CPA in Bountiful, Utah, told me that I had to pay myself like $3 an hour and I could take the rest in perquisite. And he had an extremely specialized skill set. I don't remember exactly what it was, but I'd never heard of that job before. And he knew who my father was. My dad is an entomologist, and he's very well known in Utah if you're into entomology, because he decided not to donate his insect collection to the Smithsonian, who wanted it. He donated it to Brigham Young University instead. So he's very well known in the entomological world. So if you know anything about insects, you've probably heard of my father. So I knew if you're in this category and you know who my dad is, you have a very specialized knowledge. You have a very specialized skill set. And I told him, no, your labor is worth like $300 an hour. You cannot get away with paying yourself $3 an hour. And the perks are nice, but the IRS is going to come down hard on you because you are not paying yourself as an S Corp owner, and you're not paying yourself a comparable wage. It should be a market wage. You should look up other people with this particular skill set. What are they getting paid? That's what you should be paying yourself. So if you are a restaurant owner, then you go on and you say, general manager of one restaurant makes $150,000 a year, which I think is pretty close. But it's 120,000. The owner should be paying themselves that. It is way too common in business for owners to pay their staff and pay themselves last, and then they literally are only making a couple of dollars an hour. So owner's compensation should be at market rate. So you should just go in and you should look and see what other, if you own 5 restaurants, you should be making what the general manager makes for each of those 5 restaurants, right? So you should be able to figure this out. So this is almost always the last place that an owner thinks to look, because they know what they're working for. They know what they've sacrificed. They know what they've paid in. They know how many nights they've stayed up late or gotten up ridiculously early. They know the sacrifices they're making, and they've normalized a compensation level that they would never accept as an employee. You should be getting paid at least what your employees are getting paid. And that's where, by the way, the book Profit First preaches this. It's the only thing in the book that I agree with. Everything else I think is a load. I just don't think it's a very smart book, and I think it creates overly complex bookkeeping systems. However, the owner should get paid market rate. And when I adjust owner compensation to market rate and I recalculate the profit, then I often get a very different picture of the business than what the book showed on the surface. Now, owner compensation, as in what is the owner taxed on for S corps and sole proprietors, or businesses with one owner, it is whatever the profit is. So revenue minus expenses minus cost of goods, that is what the business owner is taxed on. And as a sole proprietor, that's what they keep. If it's an S corp or a C corp, they should be paying themselves like payroll, W-2, and it should be a market wage. It shouldn't be whatever's left over. It should be, we're going to account for this, and the owner of this particular business makes $100,000 a year, and so we're going to account $100,000 a year, and it's going to be a plan for expense. So yes, we do often have to work many years to get to that point, but owner's compensation is critical, and most owners are underpaid. So that's a conversation that often changes things. So let me pull all 5 of these numbers together. Revenue trend tells me where the business is going. Gross margin tells me if the model's working. Cash position and 30-day outlook tell me whether the business has room to breathe, or are they going to be panicking because one client didn't pay their invoice. Accounts receivable aging tells me what's been earned but not collected and what conversations haven't happened yet. And owner's compensation tells me whether the profit number reflects reality. Together, all of these numbers give me a complete, honest picture of a business's financial health in about 10 minutes. It's not a comprehensive audit. We don't need that. It's not a full financial analysis. It's a clear enough picture to have an honest conversation about what's really going on and what to do about it. So, if you want to know what your 5 numbers look like, if you want someone to pull them up and tell you exactly what they see, that's exactly what a financial clarity call is for. You don't need to understand all of accounting to understand your business. You need 5 numbers, checked consistently. And honestly, I really think this should be an every morning type of a thing. But you find a time during the day, during your lunch break, after lunch, after all of your employees have left, first thing in the morning before everyone has come in, whatever works for you, you find a time every single day that this is absolutely critical. You check those 5 numbers consistently, and they need to be taught to you by someone who knows what they mean and can explain it to you. If you've been managing your business by the seat of your pants, by the bank balance and the intuition and the general sense that things are probably going okay, but who really knows, I want to offer you something better. 20 minutes, 5 numbers, an honest conversation about what your financials are actually telling you. No judgment, no skepticism, no raised eyebrows, just this is what I see in your books. You can find me at mysimplebookkeeping.com. You can book an appointment at mysimplebookkeeping.com/contact. Your first call's free for now. And happy birthday to my daughter. By the way, this is going to be published on August 7th, and that is my firstborn's birthday. I won't tell you how old she is, but she is an adult with children of her own. So I want to wish her a happy birthday. August 7th is a good day. It was a lousy day to be pregnant on, but it was a good day. I'm Donna Harris. This is Books and Backbone. Know your numbers. And if this episode resonated with you, if you feel like you know people who could benefit from this, please like, share, and subscribe. If you're on YouTube, hit the red notification bell so you get alerted when new episodes come in. Thanks for watching.